conversations with clients, liquidity, lack of deployment, complexity, and fees are probably the topics that come up most as sticking points that detract them from investing more into private markets. Private market asset classes are definitely less liquid than public markets, but they're not as illiquid as investors automatically think. When discussing lack of deployment, one needs to, as a starting point, acknowledge that private market assets need to be originated in the primary market, meaning that they are not acquired via an exchange like the JSE. This point therefore makes it all the more important that the fund manager has a strong asset origination team that has access to various internal or external resources to help with asset origination. For the point of complexity, one needs to concede that the legal contracts supporting certain private market asset classes are definitely more complex than what investors, especially those that have thus far invested solely into public markets, are used to. The standardization of, say, an in-company partnership, mostly used by private equity or mezzanine funds, have, however, definitely occurred in the last decade, and the leading asset consultants have been part of this evolution and are therefore in a position to advise their clients fluently when it comes to investing into these asset classes. In a global low-return environment, fees are more and more of a sticking point, especially if the perception is that one pays higher fees but the net return generated are similar to, say, an indexation product. However, significant alpha can be generated by investing into private market assets, and the research involved in producing this alpha is worth paying for. Having said this, an evolution has, however, definitely also occurred when it comes to fees, as they have generally been lowered, innovative fee structures have been introduced, and alignment of interest between the investor and manager have definitely been improved.